welcome back to the Smart Money channel. We cover everything about stocks and investing on this channel. We made a film about a month ago about Turkey's high inflation and deteriorating economic conditions. We're conducting a follow-up video today since the situation in the country has changed dramatically. If you haven't been following Turkey's news, here's a quick rundown. To stimulate economic growth, President Erdogan has put pressure on the central bank to maintain interest rates low. Pandemic-related lockdowns have aggravated the problem by reducing aggregate supply and increasing unemployment. The two variables combine to produce inflation rates of above 20% and a quickly weakening Turkish currency at its latest low point. Since 2005, the Turkish lira has lost up to 80% of its value against the US dollar. The delira, on the other hand, has had a huge rise in the last 5 days, climbing by about 70%. Does this imply that Turkey has now cleaned up its act and will resume its economic recovery? It's a difficult situation. At the same time, Erdogan recognized that the country's current trajectory was unsustainable due to out-of-control inflation, but he didn't want to raise interest rates, which would likely result in a painful recession, so he devised a new creative solution that would allow him to have his cake and eat it too. The Turkish Finance Ministry announced a new savings account system on Tuesday, December 21st, that will allow Turkish people to secure their liras from future depreciation. The government will compensate depositors for the value lost due to depreciation if the lira continues to decline. This is a very attractive program for Turkish savers since it allows them to take advantage of high nominal interest rates while also avoiding devaluation risk against the US dollar. The program's goal is to alleviate the lira's selling pressure. While the initiative has yet to be completely implemented, FX speculators have already bought up the price by about 70%, indicating that they expected it to be a success. Erdogan will be remembered as an economic genius if this experiment works. If all goes according to plan, he will be able to save money while avoiding a painful monetary contraction. However, this strategy is extremely dangerous and could possibly backfire. On the internet, he's taking a high-stakes bet on the fate of the currency and the Turkish economy. For the better part of last year, the lira has been in free fall. It had lost by more than 50% versus the dollar since the beginning of the year before the latest rebound. As inflation has risen past 20%, ordinary Turks have seen their savings and real incomes decline dramatically. People naturally begin to explore for other modes of payment to protect their wealth as the currency falls in value. People briefly turned to Bitcoin as a means of payment, but the government immediately outlawed it as a threat to the country's monetary authority. When people were unable to transfer their liras into Bitcoin, they began to convert them into US dollars, and a large number of people began trading liras to buy dollars. The government could restrict foreign currencies if the exchange rate depreciated as a result, but that would severely limit the country's capacity to engage in international trade, so that is not a practical alternative. The only option to save the lira is to persuade people not to sell their liras for foreign currencies. The central bank's usual response to this situation has been to raise real interest rates. As a result, Turkish bonds will become more appealing, and demand for the lira will rise. The cost of borrowing for firms rises when interest rates rise. Companies often cut back on operations and lay off workers as a result, which is the last thing the country needs given its difficult economic circumstances. President Erdogan has made it clear that he does not want interest rates to rise, referring to them as the mother of all evils. But what else can you do if you're not willing to hike interest rates? To deter Turks from selling their liras, Erdogan introduced a new savings scheme. The scheme goes like this: you put 1,000 liras in the bank. The interest rate on deposits is around 13%. The real rate is negative due to the high degree of inflation. During this time, it's probable that the lira may continue to weaken versus the dollar. Let's imagine it loses 50% of its value. The government will compensate you for the difference in this scenario. They'll give you 2,000 liras or the higher amount. In this regard, it's essentially a risk-free call option on the lira. Many observers criticize the government's idea as a desperate ruse, but it's actually a great strategy that could work. Turkey's consumer inflation will have risen by almost 20% by 2021. The lira devalued by more than 50% at the same time. So while the inflation picture is bleak, it is not as severe as it appears based on the lira's poor performance. Turkey has been caught in a vicious currency depreciation cycle. They're selling their liras because they're worried about the price dropping. The lira depreciates as a result of the selling pressure, confirming people's anxieties and prompting even more selling. As a result, they are trapped in a self-fulfilling prophecy that could cause the currency to depreciate more than is economically warranted. This savings plan has the potential to disrupt the pattern by providing people the confidence to keep their money in lira. This will relieve selling pressure and allow the currency to stabilize. While the idea may work in the best-case situation, it is also quite dangerous. Over the following year, the lira will depreciate by less than 13%. If this is the case, depositors will just get the bank's interest rate, and the government will not have to spend anything. However, if the lira continues to fall significantly, the government may be required to compensate savers. Because it is such a wonderful offer for savers, the savings squad is expected to be incredibly popular. If the government is expected to repay a major percentage of this, they will be forced to borrow money from the. If this strategy is implemented, it will be a huge win not only for Turkey, but for all emerging market countries. Currency crises occur frequently in many developing countries, including Argentina, Brazil, South Africa, and many Southeast Asian countries. Most of the time, these crises are caused by a government's or central bank's ill-advised economic strategy, but in many situations, international speculators exert undue selling pressure, causing the currency to collapse. Even when the government might have prevented the situation, currency crashes frequently result in the country requiring a bailout from the International Monetary Fund. Almost all of these bailouts come with strings attached. They frequently compel countries to implement austere budgetary measures, resulting in harsh recessions and significant unemployment. If the Turkish experiment succeeds, other emerging market countries around the world may follow suit as a stopgap measure when their currencies are being unfairly devalued. While Turkey has severe problems with its central bank's lack of independence, we should wait until Erdogan's new strategy is completely implemented before criticizing it. Signing off, Mark Smart Money.